Picture the most credentialed hedge fund ever assembled. Two of its partners had just won the Nobel Prize in economics. Its traders were the elite of Wall Street's bond desks. For 4 years it printed money like a machine that could not miss. Then, over a few months in 1998, it lost about $4.6 billion, nearly all of its capital, and came within days of tearing a hole in the global financial system. The fund was long-term capital management. Its collapse was not caused by a bad bet on one stock. It was caused by something more subtle and far more dangerous, hiding inside the way it was built. This is the story of that machine and the single flaw that broke it. Why should you care about one fund from decades ago? Because LTCM is the cleanest lesson in finance about a force that shows up again and again: leverage. This was not a reckless operation. It was cautious, diversified, and mathematically rigorous, and it still nearly took the system down because it sat on a balance sheet of roughly $125 billion built on only about $4 to $5 billion of its own money. When something that careful can fail this badly, the failure is telling you about the machine, not the people. Understand LTCM and you understand why regulators still lose sleep over hidden leverage today. Start with who they were. LTCM launched in 1994, founded by a star bond trader from Salomon Brothers and staffed with brilliant quantitative minds. Among its partners were Robert Merton and Myron Scholes, who would win the Nobel Prize in economics in 1997 for the theory of option pricing. Their core idea was elegant. Across the world's bond markets, nearly identical securities sometimes trade at slightly different prices. Those tiny gaps tend to close over time as the market corrects itself. LTCM specialized in these convergence trades: buy the cheaper bond, sell the richer one, and wait for the spread to narrow. Each trade earned only a sliver, often just a fraction of a percent. To turn slivers into a fortune, they multiplied them with borrowed money. That is the setup. So what happens to 1,000 small, safe-looking bets when the one thing they all quietly depend on suddenly disappears? Here is the machine, built one block at a time. Block 1, a convergence trade, earns almost nothing on its own. So you scale it with leverage. Borrow enough and a fraction of a percent becomes a serious return. LTCM ran leverage of roughly 25 to 1 on its balance sheet, and far more once its derivative positions are counted, with a notional book that reportedly reached over $1 trillion. Block 2. The trades looked diversified, spread across many countries and instruments, so the risk models said losses would offset. But every one of those trades shared a hidden ingredient. Each was, at its heart, a bet that calm would continue and that cheap, less liquid things would converge toward safe, liquid ones. Block 3. The flaw. In August 1998, Russia defaulted on its debt and devalued its currency. Investors everywhere fled to the safest, most liquid assets at once. Every spread LTCM owned widened instead of narrowing, and they all moved together. The diversification was an illusion. Underneath, it was one enormous bet on liquidity, held 25 times over. Now, the spiral. As losses mounted, lenders demanded more collateral. To raise it, LTCM had to sell into markets that were already falling, which pushed prices further against its remaining positions, which triggered more collateral calls. Leverage that had multiplied the gains now multiplied the losses, and the exits were too small for everyone rushing through at once. By September 1998, the fund had lost the vast majority of its capital, dropping more than 50% from the start of the year, with about $1.8 billion gone in August alone. The problem was no longer just LTCM. Its positions were so large and so entangled with the world's biggest banks that a fire sale of everything at once threatened to freeze markets far beyond one fund. So the Federal Reserve Bank of New York did something extraordinary. It did not lend public money. Instead, it gathered 14 of the largest banks and brokerages in a room and brokered a private rescue. Together they injected about $3.625 billion to take over and wind down the portfolio in an orderly way. The system was caught, this time, by the very institutions it had endangered. So read LTCM as a permanent lesson about two regimes. In calm markets, leverage is a quiet multiplier that makes small, sensible edges look like genius. In a panic, the same leverage runs in reverse, and positions that were never meant to be sold together must be sold together at the worst possible moment. The math that won the Nobel Prize was not wrong. What the models underpriced was liquidity. The simple possibility that everyone would want out through the same door on the same day. The forward question every risk manager still asks is this: how much of today's calm is real, and how much is just leverage that has not been tested yet? If you want more breakdowns of the machinery underneath the market, subscribe for the next one. This has been educational content, not financial advice.